Ever wondered who really holds the power? We see presidents, prime ministers, and kings on the world stage, but behind the thrones and podiums, there's another force that has shaped history just as much, if not more: the bankers. This isn't a conspiracy theory, it's a story as old as money itself. A tale of how finance has created and toppled empires. Today, we're diving deep into the history of how banking shaped political power. Let's travel back to medieval and Renaissance Europe. Kings needed money, a lot of it. Wars weren't cheap, and neither were lavish castles or expanding territories. But kings didn't always have cash on hand. Their wealth was often tied up in land and assets. So, who did they turn to? The emerging class of merchant bankers. Families like the Medici in Florence or the Fuggers in Germany became the lenders of last resort for Europe's most powerful monarchs. Think about it. The Medici family didn't just run a bank. They practically ran Florence. They were so wealthy and influential that they produced 4 popes and 2 queens of France. Their power didn't come from an army, but from their ledger books. When a king needed funds to wage a war, he would go to the Medici. But this lending came with strings attached. The bankers could influence political decisions, demand trade concessions, or even help decide who would sit on the throne. King Edward III of England famously defaulted on his debts to Florentine bankers in the 14th century, causing their banks to collapse. This was a stark lesson for both sides. Kings needed bankers, but bankers were taking a huge risk. This delicate dance of debt and dependency meant that for the first time, political power wasn't just about birthright or military might. It was also about credit. As we move into the 17th century, the game changed again. The Dutch Republic rose to prominence, not through a powerful king, but through its revolutionary financial system. The founding of the Amsterdam Stock Exchange and the Bank of Amsterdam in the early 1600s created a new center of global finance. The Dutch East India Company, the world's first multinational corporation, was funded by shares sold to the public. This model allowed the Dutch to fund a powerful navy and a vast trading empire that rivaled the old monarchies. Power was shifting from individual rulers to a system of financial infrastructure that could mobilize the wealth of an entire nation. The English saw what was happening across the Channel and knew they had to catch up. This leads us to a pivotal moment: the creation of the Bank of England in 1694. England was drained from wars with France and was desperately in need of cash. The solution was brilliant and transformative. A group of private bankers offered to lend the government £1.2 million at 8% interest. In return, they were given a royal charter to establish a bank, the Bank of England, with the exclusive right to issue banknotes. This was the birth of the national debt as we know it. The government could now finance its ambitions, particularly its military and colonial expansion, by borrowing from its own central bank, which was backed by the trust of private investors. This symbiotic relationship propelled Britain to become the world's dominant power for the next 2 centuries. The British Empire wasn't just built on ships and soldiers. It was built on a sophisticated financial system that could fund them indefinitely. The bank's ability to manage the national debt gave the British state a stability and financial firepower that absolute monarchies could only dream of. Now, let's cross the Atlantic to the newly formed United States. The debate over a national bank was one of the most ferocious in early American history. Alexander Hamilton, the first Secretary of the Treasury, argued passionately for a central bank modeled on the Bank of England. He believed it was essential to manage the nation's debts from the Revolutionary War, create a stable currency, and foster economic growth. Thomas Jefferson and his allies were fiercely opposed. They feared that a central bank would concentrate too much power in the hands of a wealthy, unelected elite in the Northeast, undermining the agrarian ideals of the new republic. They saw it as a threat to liberty. This wasn't just an economic debate. It was a philosophical battle for the soul of America. Who would hold the power? The federal government and its financial allies, or the individual states and the common person? When its charter came up for renewal 20 years later, it was defeated. The subsequent economic chaos during the War of 1812 proved Hamilton right, leading to the creation of the Second Bank of the United States. President Andrew Jackson, a populist who despised banks, made it his personal mission to destroy it. He famously declared, "The bank is trying to kill me, but I will kill it." And he did. He vetoed the bill to re-charter the bank, pulling federal funds and precipitating a financial crisis. Jackson's war on the bank highlighted the deep-seated American distrust of centralized financial power. This ongoing tension between the need for a stable financial system and the fear of its power would continue for decades, culminating in the creation of the Federal Reserve in 1913. The 20th century saw the relationship between banking and political power reach a global scale. After the devastation of two world wars, the Bretton Woods Agreement in 1944 established a new international economic order. The U.S. dollar, pegged to gold, became the world's reserve currency. Institutions like the International Monetary Fund, or IMF, and the World Bank were created. Their official mission was to promote global economic stability and provide loans to countries in need. However, this also gave them immense influence over the domestic policies of sovereign nations. A country needing a bailout from the IMF might be required to implement austerity measures, privatize state-owned industries, or open its markets to foreign competition. These conditions, often called structural adjustment programs, have been both praised for enforcing fiscal discipline and criticized for imposing the will of powerful nations onto developing ones. Once again, finance was being used as a powerful tool of political influence, but this time on a global stage. So, where does that leave us today? The 2008 financial crisis was a brutal reminder of how interconnected finance and governance have become. The decisions made by a few investment banks in New York and London triggered a global recession, forcing governments around the world to step in with massive bailouts to prevent a total collapse of the system. The phrase, "too big to fail," entered our vocabulary, signifying that certain financial institutions had become so critical to the economy that the government had no choice but to save them. This event sparked intense debates about regulation, moral hazard, and the incredible power that the financial sector wields over our daily lives and our political systems. From the Medici's funding kings to the IMF shaping national policies, the history of banking is inseparable from the history of power. It's a story of innovation, ambition, and a constant struggle over who controls the purse strings. The ledger book has proven to be as mighty as the sword, and understanding this dynamic is key to understanding how our world works. So next time you look at the world of politics, remember to also look at the world of finance. The real power might not be where you think it is. Thanks for watching. If you found this journey through financial history interesting, be sure to like this video, subscribe to the channel, and hit the notification bell so you don't miss our next deep dive. See you next time.